Welcome to Willis Weighs In, where we discuss controversial and newsworthy tax planning topics. My name is Ben Willis, and I'm a contributing editor for Tax Notes. Today, we'll be talking about carried interests with Monty Jackal, who is a frequent author here at Tax Notes. Monty Jackal and I met back in 2008 at PwC, where we worked on a number of partnership projects together and often had fascinating conversations in that area. I actually even took a class in partnership tax taught by Monty, which was great.
Normally people snooze through that, but okay.
I won't deny a few people might have been sleeping, but I certainly was paying attention for 90% at least.
That's better than most.
So Monty's had a very prestigious career where he has worked at the Office of Chief Counsel as well as Treasury's Office of Tax Policy. He has also been a partner and counsel in some of the world's largest law and accounting firms. Monty will not be speaking today on any matter relating to his official duties relating to his work at the IRS. All views expressed today will be entirely his own. So, without further ado, Monty, thank you so much for joining us today.
Glad to. Appreciate it. Thanks for having me.
Great. Well, I'm going to go ahead and out myself here. I didn't fully appreciate the diversity of funds that were out there. I remember when 1061 first was part of the Tax Cuts and Jobs Act, I immediately thought that it was targeting folks like Bobby Axelrod in the TV show Billions. He's a billionaire hedge fund manager who effectively came from nothing, grew up on the streets, and turned things around and became quite aggressive and successful in his career. Through conversations with folks like Monty, realized that hedge funds aren't necessarily always caught at all, even by these provisions, and that there's a number of different funds out there that actually are. And so, with that being said, why don't we go ahead and dive into what are carried interests and what is the goal underlying Section 1061, which
Okay.
I put to you, Monty.
Well, first, a distinction to be made. The typical service provider would be granted an interest in partnership profits, commonly known as profits interest, which, based on regulatory exemption in 1993, is defined as essentially an interest that does not entitle the holder at the time of grant to either a share of income accrued to date or any of the capital based on current values. As a partner, a service partner, as well as a capital partner, would be allocated a distributive shares of income, which can frequently be long-term capital gain. And the debate, which had been going on for years, and several legislative proposals were made in the context of the debate continuing, was whether or not these carried interests, and they're called carried interests because the capital partners in effect carry or support or provide the base upon which there's a rate of return that's given to the service partner. And the question is whether that return on services is more akin to a property interest or really nothing more than compensation for services income. Now, prior proposals had treated the carried interest as, in effect, compensation income or ordinary income. This proposal, so we'll get into it, doesn't address that aspect of it. It focuses solely on the holding period with respect to the asset in question. And in this case, Congress picked 3 years.
Why are hedge funds generally excluded from this provision?
Well, because those funds are basically generating profit from frequent trades. And so under common law, general tax principles, their income, whether it's going to be short-term capital gain or ordinary income, would not, in the general proposition, make much of a difference. So the focus is really on the private equity funds in particular, which buy assets or targets, wait a period of time, spruce it up some, make other improvements, and then sell. And the proposal, the legislation in 1061 does not deal with whether the target asset is in fact a capital asset or not. That issue was addressed and still open question in the Sun Capital line of cases, which were pension control cases in the First Circuit up in Boston. But the basic gist here is that if you have a relatively short holding period that is with respect to the applicable partnership interest, and that under the statute is a partnership interest that where the partnership is engaged in trade or business of investing and developing and returning capital and investing in and trading specified assets being what you would understand them to be, corporate stock, whether or not it's publicly traded, commodities, cash or cash equivalents, partnership interests that hold to the extent of the proportionate interest represented by the specified assets, and then real estate held for rental or investment, which we'll get to in a bit. And then you need to identify who the taxpayer is, that we'll address in a moment. And then just to note that interests held by corporations or capital interests are not covered by the new statute.
Well, I'm definitely interested in corporations and talking about that, as you know. Thank you for that explanation. It helps me appreciate the fact that hedge funds have turnover of their inventory, which is investments, that is so fast that it doesn't actually often provide for the long-term capital gains rates that private equity funds and their managers are afforded. So that's definitely helpful. So speaking of the length of time that they're holding on to assets, as well as the length of time that a fund manager needs to hold on to a partnership interest, why the 3-year holding period, and does that really get at minimizing the benefits that Congress was intending to?
Well, Congress chose 3 years. I mean, a recent congressional research report, I believe, put the average period of time that a private equity fund would hold before selling somewhere between 3 to 5 years. Depending upon if you're either a skeptic or an optimist in terms of why Congress picked 3 years, either because they wanted to make sure that the trade, that the activity would be covered, or that it wouldn't be covered. And if you have a legitimate running holding period of more than 3 years, then generally speaking, you're not in the statute, and you'll go on your merry way and receive carried interest and a favorable tax treatment. Which candidly just really gets to when the statute talks about with respect to the applicable partnership interest or API, question becomes who is the taxpayer and what does the statute apply to? And the taxpayer, there's some confusion here because that's not a defined term, but the statute most likely means in the context of the person who actually does the netting of long and short gains and thereby computes the tax under Section 1H, is most likely the ultimate owner up top who's provided the services or a related party to that person, so that you wouldn't have situations where a non-service partner who invests in the upper tier partnership would be subject to its allocable share and be restricted under 1061. That would make no sense. And then there's a question of what to do with lower tier entities, meaning are they tested separately, at least initially, with respect to whether they're in an applicable trade or business, or is a test also performed at the owner taxpayer level? If the owner taxpayer, I mean, the one who includes an income, was a lower tier entity, that would in itself lead to anomalies because you would characterize the gain, let's say a short term, and then it would flow all the way up, and the capital providing partners in the upper tier would also be subjected to 1061. Makes no sense. On the other hand, if the upper tier partners contributed capital and the services were being provided by, let's say, an upper tier partnership or a management company that was owned by an upper tier partnership, then you would have a question of whether the test in determining whether you have an API is done at that level, meaning the upper tier level, or flows all the way through to the top. And the answer generally should be that it's tested at the level of the entity, that meaning an entity approach tested at the level of the entity. If it's lower tier, that's actually doing the services. And just an open question here that I know has been raised is, what do you do with distributed assets that go to, let's say, the partner, service partner, with an in-kind distribution, and then the assets sold all within 3 years? What do you do with that? And I know that they're thinking at one point in time inside the government may have been along the lines of that the distribution of an asset was made because you owned an interest in an API, and therefore it's with respect to the API, and therefore it's covered regardless of your intent. On the other hand, it could be an intent-based test, but I'm sure that will be covered when the regulations come out because it's an open issue. Much like whether you can hedge or otherwise collar a partnership interest or a partnership asset, age to holding period, and then sell when more than 3 years it runs out, or whether in a manner similar to what was done in the ozone regs, in effect provide a holding period, anti-abuse rule, to prevent that circumstance from occurring.
You did cover quite a bit there. So just to reiterate for my own benefit, in focusing on who the taxpayer is, just based on your explanation, it seems that in looking through tiers and different assets and businesses, they're really trying to get at the fund managers, the service providers, and the businesses that are of focus in the statute.
Yeah, what they're really trying to do is they're trying to, in effect, treat, if you have a tier of partnerships, basically treat it as a single partnership in the context of, who's going to include the gains in income, but then to recognize that separate entity treatment may be appropriate, at least initially, in determining whether you have the activity that's covered by the statute.
Yeah, based on the assets.
That was called in a major bar report as the partial aggregate method, which makes a lot of sense. Of course, it doesn't make much sense, as I was going to ask you. The statute excludes corporations. What do you think about the IRS notice in 2018 about S corporations not being corporations for this purpose?
Oh, put me on the spot there. I like that. I have to take issue with that notice. I thought that was an incredible overreach by the IRS. who is subject to the same rules that courts are, and we all are, in interpreting the plain language of the statute. The Tax Cuts and Jobs Act specifically use S corporation in certain places and corporation in other places. The transition tax, for example, made several exceptions for S corporations. Even subchapter S, has its own incorporation and includes S corporations, along with general tax principles. What I found is so interesting is that the IRS has consistently argued both sides of the position based on what will generate the most amount of tax revenue.
Speaking of taking inconsistent positions on an issue, how would you treat, for example, qualified electing funds, which are foreign corporations, which are passive foreign investment companies, which, if they make an election to be treated as a pass-through, can pass through ordinary income and capital gain? They're, unlike the argument, which apparently the government doesn't accept, that corporation means corporation, doesn't mean just C corporations. For in the case of a QAF, it's clearly a C corporation under the code, but it's also a pass-through. What do you think of that as a corporate guy?
Well,
There.
I hadn't thought about that before, to be honest. I gotta say, I think it's either similar to or even stronger than the S corporation argument. In other words, an S corporation is a corporation, a qualifying corporation, a small business corporation that merely makes a tax election and gets flow-through treatment. You're pointing out these qualified electing funds that are subject to the PFIC rules and their ability to basically elect to have this flow-through treatment that's somewhat similar to S corporations. So I would argue that they would follow my same logic with respect to S corporations and be treated as corporations for purposes of 1061. What are your thoughts?
As I may have heard a while back, I can't recall any longer. Some may be of the view that, heck, these are only proposed regulations, and clearly, if Congress had thought about it, it would have provided such a rule, meaning don't treat QEFs as corporations for this purpose. On the other hand, doing so, respecting what the words say in the statute, allows you to circumvent the whole purpose of 1061. Same with S corporations, and the question is whether or not the government, IRS, Treasury should have the pen in terms of rewriting the statute, because it doesn't seem to work.
I have heard that argument that you just made, that the 1061 is designed to prevent certain abuses, and therefore there should be additional discretion. At the same time, the code is filled with anti-abuse rules, and you can't impose a penalty or beyond what Congress specifically provides. And so I don't think the fact that 1061 is intended to prevent some abuses in certain instances based on a holding period should give an agency any more deference or discretion than it otherwise would have.
Well, candidly, in order to effectively police the bad habit, actually, I would call, of the government to take it upon itself, at least in certain circumstances, to rewrite statutes and regulations the way they think it should work, and not wait for a technical correction. That just, unless a penalty, see, the difference between taxpayers and the government is that taxpayers incur penalties if they take a position that's not supportable or not supportable enough. Government, in writing rules, doesn't have a penalty if it loses in court. Presumably, if it loses in court enough times, it'll change its behavior. You could argue that that is inappropriate type of behavior on the part of the tax administrator in order to put taxpayers in such a bind. And yet it's an indisputable fact that that's in fact true. So, so there's nothing we can do about it other than to challenge positions when appropriate and then see what the courts say.
Well put.
And candidly, I think just what I was mentioning, wanted to just get out before I forget, on the capital interest part is the statute is really worded very funny in terms of, it just talks about um, amounts contributed at the time of receipt of the partnership interest by the service provider as being the capital interest. You would expect any rules drafted here to at least spell out what a capital interest, how it's computed. You're basically going to be looking for a reasonable rate or arm's length rate of return to a non-service partner. And that, to that extent, it will be excluded, you would expect, from treatment, because what the statute's looking to is return on the services component. And by the same token, a taxpayer who has long held assets in the business prior to January 1, 2018 would not have kept records, or you would expect would not have kept records to determine whether what they're holding today is with respect to services or capital or what. And so it wouldn't surprise me if there was some form of transition relief provided in the regulations for those holdings on January 1, 2018. It would make a lot of sense if it did.
I was always been curious why 1231 property is basically excluded from the statute, which focuses on 1222 property. And so I'd be really curious to get your thoughts on that.
Well, the 1061 appears to be written with the focus on 1222 holding period being deemed to say 3 years instead of 1 year. And when you go into a statute like Section 1231, it has a 1 year holding period. So 1222 is not controlling the result, and therefore you could conclude fairly reasonably, even though it's not in the interest of the government to say so, you would expect that a reasonable conclusion would be that 1231 property is not, and gains are not subject to 1061. I mean, the same could be said about 1256 assets. The same could be said about when you go into Section 1H and you look to the computation of net capital gain. Some of the subcategories there have their own separate holding periods, and therefore you would expect that to be excluded as well. That's not to say that, even though I do recall exchanging some ideas back a year or so ago on these issues, I guess I didn't anticipate the government review in the OMB as happening more than once.
You're right. I just thought it would be more of a focus because it was a campaign promise and part of the administration's goals to try to eliminate the loophole of carried interest, as they stated. And so I was just curious, one, what's taken them so long in getting these rules out, and why the back and forth at OIRA?
Well, I think what's happened is that when you're not really confident of the rules you've written and you fear that you could get substantial criticism for them, and the area of law is, in your mind, not as important as others, to take the negative criticism, you would normally expect to at least put out a trial balloon in form of proposed regs and then retract your position and tighten it up if need be. That's not what happened here, apparently. And if that pattern continues, it's just not a good look for the government. It just conveys an image that you don't like to see. And as a former government person, I didn't like to see something like that happen. I think I had an idea about certain abuses or things that could occur under the statute.
I'd love to hear about that.
Oh, okay. I mean, just to because I know this has been raised elsewhere. There's an issue about what are called carry waivers, where you have an allocation of, let's say, more long-term capital gain to a service provider than short-term gain, with a makeup somewhere down the line. That could be viewed as, if there's sufficient economic risk in the swap, be respected. And if there's not enough economic risk of ups and downs, then perhaps it would not be respected. And one would expect to see something about that in these regs that are coming out. There's also a question of revaluation through the various tiers, which the general subchapter K rule would only, if you had a revaluation at upper tier, not revalue at the lower tier with respect to its assets. However, if you don't do that, the economic gains that have appropriately accrued to the service provider will be mismatched with the actual gains and losses for tax purposes in, for example, a lower tier where a revaluation occurred at the upper tier. That's just something that needs to be addressed. Exactly how they'll do it, we'll see in the regs. A similar concept with trying to hedge that we talked about earlier, age your partnership interest by collaring it or putting it in a straddle or something related to it. And there was also some talk about planning about recapitalizing your interest in the partnership and try to separate out the tax attributes attributed to capital, solely captured in one portion of the interest, and then the other portion of the interest being solely services. I would guess that what will happen there is that will not be treated as working because of the general proposition on the Rev Rule 84-53 that tax attributes are normally, like holding periods, are spread among all the assets. And then the last but not least, are related party transfers. And there's a provision 1061D in the statute, and that deals with transfers to related parties. No one quite knows what that means. It could either be written so ambiguously that the government will not try to enforce it at all. I don't think that's going to happen. It could be viewed as a recharacterization rule, like Section 751A, in which case it would just recharacterize as short-term gains that are otherwise long-term that would be realized and recognized in the normal course. And the last possibility, and probably the one that would be chosen, although I don't know for sure, obviously, would be it's an income acceleration rule, like an assignment of income, where it goes to related party. So if there's complexity in the regulations, as I expect it would be, it's because you're attempting to cover, in a very limited statute, you're attempting to at least make it apply to the appropriate parties. And if doing that makes it unpopular, then so be it. That's the statute that Congress wrote. I think it's a job of the tax administrator to make what Congress did work to the extent you have authority to do so. And if there's criticism that comes from it, so be it. But I don't know if that's the prevailing view anymore. I don't know if it ever was.
I know I've learned a lot today in talking with you and preparing for today's discussion, and I know our listeners certainly are going to take a lot away from this. Hopefully, regulations are promulgated and consider a number of the points that you've raised, and if not, this discussion at least will help illuminate things for taxpayers who have to make difficult determinations in interpreting these rules. So with that, Mr. Jackal, I will say thank you so much for joining us today on Willis Weighs In to discuss carried interests. And let me just let folks know that you are now practicing on your own under your banner Jackal Tax Law. And if folks want to reach you, they can at money@jackaltaxlaw.com.
Appreciate you having me.
Glad to have you here, Monty. For those watching and listening, please don't hesitate to reach out with any questions or comments. I love feedback and I love tax law, so please reach out. You can find me on Twitter at WillisWeightsIn, or you can email me at ben.willis@taxanalyst.org.
Willis weighs in.